Well, we'll go ahead and get started. I appreciate you guys coming. My name is Nate Hare. I'm the executive director at Directed IRA, the fastest growing self-directed IRA company in the country. We're really excited about that. But what we're really excited about is to bring on great expertise and great speakers to help all of you become better investors, but specifically better self-directed IRA investors. If you guys are new to the program, what we do here at Directed IRA is we allow people to use their retirement accounts, old 401ks, rollover IRAs, and invest in alternative assets, things like real estate, promissory notes, investments into syndications, which we're going to talk about today, real estate funds, anything that's considered an alternative investment is what we allow our clients to invest in with a, quote, self-directed IRA. So if you're new to the program, we talk a lot about this. We've got a website. If you go to directedira.com, we've got a lot of education about what a self-directed IRA is and the things you can invest in. This isn't so much that program. We're going to be talking about due diligence. I'll wrap it up with IRAs at the end, but this is really to talk about how do you as an investor analyze and investigate certain investment opportunities, because with a self-directed IRA, you have to do that type of due diligence. You have to have good due diligence practices so that you invest in things that you're knowledgeable about and things that are safe for you. You can't rely on your self-directed IRA custodian to do your due diligence for you. And that's the same across the board, no matter what self-directed IRA company you work with. So the best thing about a self-directed IRA is you get to pick the investments. But the worst thing about a self-directed IRA is sometimes you get to pick the investment. So you just need to make sure that you are picking wise investments, because when it comes to us, we're not going to tell you whether your investment's good or bad. We're just going to say, cool, you want to invest in that syndication? Cool. You want to buy that rental property? Here are the documents you need. And we take your direction to make that investment happen. But as far as telling you whether it's a good one or a bad one, that's up to you to decide. So without further ado, I want to bring on my good friend, Tom Barry. Tom, how's it going?
Fantastic. Thanks for having me on.
I appreciate, I'm going to just tell just a quick background about me and Tom. I've known Tom since 2012, I believe. So about a decade now. Tom has been through a lot of different real estate cycles, I will say. Tom's done a lot of different things in real estate. And Tom is probably at the very, very top, in my opinion, when it comes to educating investors. He spends a lot of time traveling. He spends a lot of time doing this back in his home town of Houston, educating investors of all sorts on how to just become better investors. And I appreciate you sharing your time with us here today, Tom.
Absolutely. Thanks for having me on. I appreciate it.
Yep. So let's just jump right into it. Tom, tell them a little about yourself, and I'll let you take the controls and start sharing some of the good content you got for us.
All right. Well, let me switch over to screen share here. And okay, are you able to see the presentation there, Nate?
Yep, I can see it. Yep, it's perfect.
All right, very good, very good. So I'm going to talk I've probably only got really 15 slides of content, but I'm going to tell a little bit of stories and background and things like that to try to give some context to the content rather than just regurgitating a bunch of facts. So due diligence for funds and syndication. I'm just going to jump right in here. Obviously, I got to start with some disclaimers. Keep all the attorneys happy. This is intended for information and training purposes only. I am not guaranteeing anything that I'm saying here. I'm not giving any tax, legal, or investment advice. Fact of the matter is nobody has a crystal ball. So honestly, at the end of the day, any presentation like this is really just one man's opinion. And also, I will mention a lot about funds and syndications, but I don't want anybody to think that this is a syndication of a particular investment. Investments should only be made after careful reading of the PPM or other investment disclosures and after consultation with your CPA, attorney, and financial advisor. And honestly, with good due diligence, which is exactly what we're going to talk about through this presentation, because everybody that talks about an investment is going to give you some kind of disclaimer similar to what I just gave, which says I know nothing. It is up to you to make up your own mind about this particular investment. And well, that creates a challenge, because how do we do that? How do we, as passive investors with our self-directed IRA account, how do we do this due diligence that everybody talks about? And that's what we're going to go over the next 14 slides or so. As Mr. Hare just mentioned, I have been in real estate for quite some time. I started in 2004, full-time since 2007. I have done nothing but real estate investing in pretty much every capacity I think you could do. As you look at that bio there, that is a brief synopsis of some of the things that we have invested in. Everything to meat processing plant to exotic game ranch. We just closed on our second shopping center a few weeks ago. And I'm going to keep mentioning that shopping center in Dayton, Tennessee, that we closed on a couple of weeks ago, simply because all the facts are still fresh in my head. That's the last deal we did. And I think I can continually use it throughout this presentation to draw some comparisons with. That's pretty much about me. I'm not going to get into a bunch of that. Basically, what I want you to know is I've been around this stuff a long time, and I have seen a lot of people do really well investing in alternative investments, and I have seen a lot of people lose money and lose their tail investing in alternatives, just like you could say about the traditional investments in the stock market. A lot of people do really well, and I've seen, particularly in down markets, people lose their shirt as well. This is really no different. It's just a different asset class. So let's start with the current state of the economy, and I leave this blank because I've given this talk several times across the country at different groups. And every time I give this talk, well, this slide would look different, right? So today, if we looked at the current state of the economy, we would have to acknowledge the fact that we've been in an inflationary period for quite some time now. I would certainly stipulate that we are not at peak inflation. I think inflation peaked around a year or so ago at about 9.1%, according to the government numbers. I could take issue with that, but that's on a different presentation. Now, last month, I think we were down to 4.1%, which is still just a little over double what the Fed wants inflation to be and what their mandate is to get inflation down to. If we look at the economy, we've also got to talk about interest rates. And that, of course, was a reaction to the high inflation. And interest rates, particularly in commercial real estate, and by the way, pretty much all real estate that you're going to deal with in your self-directed IRA is considered commercial real estate. Even if it's a single family home, it's going to be a commercial purpose property, meaning it's either going to be purchased to flip or purchased as a rental or purchased as a short-term rental or Airbnb. It's going to be a commercial purpose property, which means you're going to need a commercial purpose loan. And those loans have skyrocketed in rate over the past year or so. So those are some of the things that we have to look at when we look at the current state of the economy. We could also look at the commercial real estate bubble, which is what a lot of economists are calling it, and the fact that a lot of people think that commercial real estate is going to quote unquote collapse. Now, I think that's a very dramatic word. I don't think I would use that word, but certainly some economists are. I think in certain sectors of commercial real estate, we're going to see a softening, and certain sectors we've already seen a dramatic softening or a slight crash. Case in point, office buildings. Stuff that used to sell at a 7 to 8% cap rate is currently selling at a 12 to 14% cap rate. Prior to that, we had the same thing with hotel motel. That has stabilized somewhat, but we've got a lot of things going on in these different sectors of real estate. And I wanted to put that first because with all of these different dynamics, it's very important for you to understand the dynamics of what you're investing in before you're even capable of doing your quote unquote due diligence. So where did this class come from? I built this class out of a personal need. I had a desire to be able to efficiently and effectively vet a deal or analyze a deal that I was not involved in as a principal manager or sponsor. So my business partner and I, we have done very well with several companies. We had a little bit of extra money we wanted to invest, and we said, look, let's invest in some things that we're not involved in. In other words, we don't manage, so that we can spread our risk around and not put all of our eggs in any one basket, even if it's our own basket. So what I wanted to do, it's my job to do the vetting of the deals. That's our relationship. So I said to myself, I want to outline that I can follow to do due diligence quickly so I can do more deals in less time. In other words, I could analyze a lot more potential deals that we might invest in, but I could do it quickly and get through a lot of them. Because the truth be known, if you have a specific thing that you want to invest in, you're going to have to look at many of them before you find one that's going to fit your criteria. And I guess before we get into criteria, I want to also set the stage for those that are not familiar with these two terms, funds and syndications, which they are two different things. I wanted to just kind of go over a general description of what those look like and how they are different. So a syndication is usually, and you're going to find that word usually in all these descriptions because they don't always have to be, but usually a syndication is known as one asset with multiple investors involved. So one or more partners is going to get together and they'll be called the sponsor. They are basically the one or the group that has the experience, and they might also be considered actives. You'll hear that term as well. They are the active participants. In other words, they're the ones that do all the work. They're the ones that make all the decisions. They're the ones that handle the day-to-day. Now, the rest of the partners bring something other than experience to the table, and that is usually money, okay? So the active is going to go out and raise capital from the passive investors. And in addition to bringing money, they might also bring net worth, income, credit, maybe even they're signing their name on a personal guarantee needed for the acquisition loan. But they're bringing something other than experience. Now, these partners are typically going to be passive participants. A lot of times, if it's set up in a partnership legal format, the active sponsor is going to be called the general partner, and the passives are going to be called the limited partner, because they are limited to what they're going to be doing, and they are limited to the say that they have in any of the day-to-day operations. Now, a fund, a private fund, is a little bit different. It's usually defined as multiple assets with multiple investors. Now, one or more of these partners is going to be called the manager, and the manager is the one with the experience. The manager is the active participant doing all the day-to-day. The rest of the participants are passives. They're just investing. They're just putting their money in that deal or in that transaction. The good thing about funds and syndications, while they are vastly different, the due diligence for investing in either one is almost identical. So we can talk about them generally here together, as opposed to having to have a completely separate program for one or the other. Now let's talk about a couple of the advantages of syndications and funds. We'll start with syndications. In a syndication, you have experienced management. If you didn't, you certainly wouldn't want to invest in that particular syndication. Professional teams. These are typically people that do this for a living. They have a business built around this particular model, and they're very professional in what they do. I have personally some friends that run apartment syndications. These guys are guys I've known for years and years, and there's no better people in the apartment space than these apartment syndicators. Now, I also know some apartment syndicators that I would never touch their investments with a 10-foot pole either, because they're not experienced, but yet they are still out there raising capital. And one particular one, you can look this up, Google it, apartment syndicator, Houston, Texas, just lost hundreds and hundreds of millions of dollars last month in a syndication that went sideways. And you can read all the corresponding articles on it and see that this particular group did not have a lot of experience, yet they raised millions and millions of dollars of capital from, let's be quite honest, passive investors. Many of those investors may have even used self-directed IRA funds that didn't do their due diligence. Or if they did, they didn't have a very good due diligence plan. So what you're getting in a syndication, if you're doing it correctly, is experience, track record, professional teams that know what they're doing. These people should have a very unique sub-market insight. I have a friend that does self-storage syndications. And look, if I wanted to know anything about self-storage, I'm going to pick up the phone and call this guy, because I don't know anybody that knows the sub-market any better than he does. They have a unique insight into it because they talk to people in that market all day, every day, and they know the ins and outs of it. A guy like me that does not particularly invest in that, I would have only a small amount of knowledge of that particular sub-market. The other thing I think is an advantage of a syndication is there is a relatively small investment requirement, which allows, let's say you have $1 million in your self-directed IRA and you want to invest it across multiple projects, right? Well, syndications allow for that because most syndications will allow an investor to get in maybe $50,000 as a minimum investment. I've seen some as high as, $250,000 as a minimum investment, but most of them are going to be in that $50,000 to $100,000 range as far as minimum investment. So if you had $1 million that you wanted to spread, you could do some of these smaller minimum investments and get a diverse offering or a diverse portfolio of projects under your belt with that $1 million. And then the other advantage of a syndication is it's just totally passive for you. As a passive investing in a syndication, the only work you have to do is your initial due diligence to determine if this is worthy of your investment dollars, and your follow-up due diligence, which is the ongoing due diligence that you want to do to make sure it's worthy of you staying involved in. That's it. Other than the DD, the due diligence, there is really nothing you have to do. Now, let's look at the advantages of investing in private funds, and you will notice that the first ones are exactly the same as the advantages in the syndication, except I've got a couple of extra ones at the end. Being in a fund, and again, most funds are set up this way, not all, it allows you the opportunity for diversification within the fund itself, which means, I'll use the example of our note fund. We have a real estate note fund called the ILS Growth Fund. That fund has about $86 million of investor capital in it. We've levered it a little bit, and we have about $112 million worth of real estate loans or notes in that fund. Now, anybody that invests in that fund, it has a small minimum buy-in of $50,000. So if you put $50,000 in that particular note fund, you own your pro rata share based on how much money you put in and how much money is in the fund of all the notes in that fund. So rather than you going out and taking your $50,000 and buying one note with it, which actually would be somewhat challenging in today's dollars to find a note for $50,000, most are going to be more than that. But even if you could find one and you bought it for your 50, you only own one note. And if that note goes sideways, 100% of that $50,000 investment is sideways. In other words, not paying you. Where in a fund, if you've invested in a note fund, you own a tiny little sliver of every note in that fund. And trust me, in a large fund of 86 million investment dollars, if a $50,000 note went sideways, you wouldn't even know it, because it wouldn't even be a blip on that balance sheet or on that P&L for the month. So that diversification within the fund is a huge advantage over a syndication that might only have one asset. The other one that I think is a real valuable point to make is a lot of private funds have a short lockup period. If I'm going out and buying a shopping center and I'm syndicating that, or if I'm buying it in our equity fund, I'm going to want a 5-year lockup on your money. In fact, I might even not tell you what the lockup is. It might be a case where I say, we expect to sell this property in 5 years and have full payback of your principal at that time. Well, with the purchase of an asset, whether it's a shopping center, an apartment complex, or a self-storage, you don't really know when you go into that transaction how long that transaction has to hold, because we don't know what the market is going to do. We want to sell when it's right to sell, not when our investors force us to sell. But with a lot of private funds, and particularly I'll go back to our note fund, we have notes coming in and going out every single month, so we can have a real short lockup period on that capital. So our note fund has a 12-month lockup. So what that means is that if you put your money in that fund, you're agreeing with us that you're going to leave it alone for 12 months. After that, you can redeem a portion of it or all of it at any time you want to. And that's one of the advantages I think funds have over most syndications, because syndications are typically done on physical assets. Private funds can be done for notes. They can be done for funds of funds. There can be a lot of different uses for a private fund. So due diligence is very similar for funds and syndications, and I broke it down into 3 categories. There are 3 categories of DD that we have to do for a fund or syndication. And I break it down and call it the 3 Ps: the people, the project, and the paperwork. Those are the 3 things that I have to do due diligence on, and I have to sign off on each one of these in order before I move to the next one. Because to me, this is the proper order: the people first. If I can get past the people part and they check out, then guess what? I'm moving on to number 2. But if I can't check off that I like the people in this project, I'm not even moving to the project itself. And if I can't get past those 2, I'm not going to move to the paperwork. Again, I'm looking for an efficient way to analyze more and more deals in a short period of time. And like all good deals, you're going to have to go through numbers. It's a numbers game before you find one that fits all 3 of your sets of criteria. And we'll get to the criteria here in just a minute. Now, general investment criteria. This is something I wish I could get everybody that invests in alternatives to grasp this concept. I think this is probably the most important slide in the entire 17-slide presentation that I'm sharing with you right now. You have to have a written investment criteria before you start investing. You have to. If you don't, you're going to start following your heart instead of your head. You're going to start following people instead of facts. You're going to start following emotion instead of logic. But if you have a written investment criteria, it will keep you from making some of the most common investment mistakes that are made out there. So what would I use in my written investment criteria, which my business partner and I sat down and we wrote ours? We will only invest in this, this, or this. And it's 3 things that we will invest in. And in each of those categories, we have further broke it down. And if we're going to be investing in this, it has to meet this, 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 and this. Now, I'm couching and not giving you mine because everybody's is going to be different. Everybody should be different because everybody is at a different place in life, a different cycle in their life. You know, I'm in my late 50s. Some of you might be in your 30s. Well, our investment criteria should not look alike. Some of you on this call might be in your later 60s or early 70s. Yours shouldn't even look like mine because, again, we're at a different stage. And we're also at a different point in knowledge. We're at a different point in risk tolerance. We're at a different point in capital investment available. I mean, all of these things are going to determine what your criteria should be. So I'm not going to tell you mine because I don't want anybody just copying it down and saying, hey, this is what Tom said I should invest in. No, not at all. But some of the things that you should look at is, what type of investments will you invest in? Real estate? Okay. Real estate is too broad. What real estate asset class will you invest in? Where will you invest? What geography? What state? What city? What market? Or what states? What cities? What markets will you invest in? Asset size. You know, I can tell you if somebody calls me up and says, and I'll use one example, you know, we buy shopping centers. As I mentioned before, we just closed on one a couple of weeks ago in Tennessee. We will buy shopping centers in 28 states that we have identified that we would be okay owning in. And how did we do that? We looked at the landlord-tenant laws in those states, eviction laws in those states. We looked at those states and said, are they business friendly? Are they going to kill us with taxation? Are they going to make it hard for us to get permits? How easy is it going to be to do business? And we've identified 28 states that we can live with their rules. Others, not so much. We've identified many states that there's no way in the world at any price we would buy a property. So we've identified the geography. Now we have to say, what size? And for us, we like shopping centers with an asset price of anywhere from 3 million to 10 million. That's what we're comfortable with. Anything less than that, I'm not going to look at. Anything more than that, I'm not going to look at. And the one we closed the other day, we closed for 7.725. It's right in that wheelhouse of right where we want to be. We also have looked at population count. If we buy in a particular market of a state that we have agreed to buy in, that market has to have a population of X or bigger. And if it doesn't, we don't buy there. Vehicle per day count. In other words, traffic that is passing past our shopping center has to be at a certain level or above. And I hope some of those things give you an idea or a glimpse into what a general investment criteria should look like. Other considerations might be, how long do you want to have your investment locked up? Do you need monthly cash flow? Or are you comfortable deferring all your earnings to a later date? Or are you looking for an investment that does both? Some cash flow ongoing and the rest at the end. There are investment projects out there that follow all 3 of those types. But if you're a retiree and you need that income, well, then you're not going to want to do a 5-year deal where you don't get paid until the end of 5 years. You're going to want to do something that provides you ongoing cash flow to live on, I would assume. Is this a cash flow play or an equity investment? That's a very big consideration. Cash flow plays are going to pay out immediately, but they're not going to pay as much over a length of time as what the equity investments expect to pay. But the cash flow investments have a lot less risk than the equity plays, because the equity plays typically are going to be dependent on a multitude of things. They're going to be dependent on value add or redevelopment or repositioning. They're going to be depending somewhat on appreciation and principal pay down of the mortgage. All of those things have if factors involved. None of those are guaranteed. None of those are something that you can count 100% on. So there is a difference between that risk and that reward in each of those levels. And then how much risk return are you comfortable with? Do you want to invest cash or structured funds such as your self-directed IRA? Are you okay with UBIT, unrelated business income tax? And Nate can certainly get into that in more depth. Are you looking for depreciation write-offs that will pass through? Well, if you are, you don't want to use your self-directed funds, you would want to use cash. All of these investment criteria on this sheet, and honestly, we could have filled up 3 sheets. I just wanted to kind of give you a taste of what it would look like. All of these things are going to determine the type of project you're going to invest in and the type of buckets of money you're going to want to use, whether it's the self-directed bucket or whether it's the cash bucket. All right, now to the actual due diligence and what we look for in that due diligence, at least when I'm doing it. We're starting with the people. Again, the people, in my opinion, is the biggest one, and it's the most important one. Here is a list, and if you want to take your phone and take a picture of this slide, I'm going to leave it here for a couple of minutes, but I'm going to roll through it pretty quickly. But a few questions that I have is, how long have you been in the industry? Right? I want to know that this is not a Johnny-come-lately, because let's face it, in real estate in particular, if a person you're investing with doesn't have at least 17 years of experience, they have never seen a down market. All they have seen is good times, easy money, cheap money, and easy returns. That is all they've seen. Anybody that couldn't make money in real estate in the last 15 years, they really should not have been in real estate, because it's been probably the easiest in my lifetime to make money in real estate. Anything you bought would work because we had nothing but up market. Now we're at a different place. We're at a different point in that market cycle. So I want to be with people that have been there the last time it was rough. And I want to know how they fared. How did they do when it was rough? Not how did they do in the last 15 years. A 12-year-old could have made money in real estate in the last 15. So how long have they been running this particular model? What is their track record? Have they been beat up? And if they were beat up, in other words, did they have any bad deals? You know, you talk to me and ask me, Tom, have you ever lost money in real estate? I'm going to say yes. And anybody that's being honest and has done a lot of deals is going to say yes. It's not a 100% thing. Now, I'm going to hope that you would ask the next question, has anybody ever lost money that was invested with you? And I'm going to say emphatically, hell no. I have made every single investor whole, even if my wife and I lost money on a deal. And then we can talk about those war stories, and I can share my scars with you and how we handled it and what we learned. That's the kind of stories I want to hear when I'm asking guys and gals that I'm vetting. I want people that have been through war. I want people that have had challenges, because if they've had nothing but easy, I don't know how they're going to react when things go sideways for them. And I didn't say if, I said when. Real estate is not perfect. There's always something that goes sideways. So are they mentally tough? Can they handle it? Other things I look for is, do their morals, character, and values align with mine? Look, if they don't, it's just not somebody I want to do business with. They still might be great people as human beings, but I like to do business with people like me. And I guarantee you most people listening to this would agree with that if we were being honest. People like to do business with people that are like them. How much of their own money is invested in the deal? That's a great question, because if my money is going in and yours isn't, trust me, my money isn't going in. Okay, I want your money at risk right along with my money if you are sponsoring a deal that you're pitching to me. Do they run a low expense investment, or do they eat up a lot of the profit with fees to their related companies? Now, why am I saying that? Trust me, I have read so many private placement memorandums where they have other companies on the side under a new name or different name or their wife's name or whatever. And that company provides services to the actual investment, and they funnel a lot of the profits right off to themselves, right off the top. It happens, and it happens a lot. So I want to know that they're running low expense investments. I also want to know about related businesses that are doing business with the investment. And then I like to look at their personal finances, their personal life. Do they live frugally? Because look, if they're frugal in their personal life, they're probably going to be frugal with their business as well. But if they are, just living larger than life, they're probably going to spend investment money the same. So that's important for me. May not be fair, but I think it is, and I use it. How do they make their income? Do they have multiple streams of income? Or are they living off of these investments that they are asking me to put money in? Because let me be honest, if they have to have income off of this particular investment to eat and feed their family, I'm not interested. Because desperate people will do desperate things in desperate times. Even good people will do desperate things in desperate times. I want to do business with somebody that has multiple streams of income. This is something extra that they're doing. They're good at it. They know what they're doing. They've been doing it for years, but they are not relying on this particular investment to feed their family this week. And then are they stretched too thin to focus on the project you were investing in? That's another challenge that I've seen over the years where guys have too many projects going and they start this next one and they're stretched so thin, they don't put any focus on it. And the investment goes sideways as a result. So for me, that is not an all-exhaustive or an all-inclusive list, but it is certainly a taste of the types of things that I like to ask when I'm doing the due diligence on the people.
Hey, Tom, I got a question from RJ Rodriguez, and I think I know how you're going to answer that, but I want to just throw it out there. It says, how do you determine if their morals and values align with yours?
Morals and values, we'll get into those discussions. We will also do a background check. And look, if they're not quick to say, sure, you can do a background check on me, then I'm not going to do business with them. I provide my investments to groups that do a background check on me before they allow me in the mastermind, before they allow me in the group. If I am not transparent enough to allow that, then you shouldn't do business with me. Also, Google is so amazing right now. I can literally type in a name, and most generally, I'm going to be able to find a picture to verify that's the person I'm actually looking for, and for free, without any signature from the person I'm checking out. Look, as an employer, every employer does it. There is so much information out there. It is pretty easy to see what the character and morals and values of a person are these days.
And I'll just add something. I've been in the self-directed IRA industry for over 10 years now. And one thing that I'll tell you about self-directed IRA investors is you have to make relationships. And I think through relationship and networking, you'll find people that align with you, whether that's on a moral level, character level, or their values. But what I would urge people not to do is invest in people they haven't met, invest with people that they haven't talked to. Um, Attend your local real estate investor clubs, get out there and attend events. I see Tom at almost every event that I'm at, and that doesn't mean they're in Texas. I mean, we saw him in Arizona last week. I mean, he's still making relationships, but I think that's the best way to do it. It's not over the phone. Sometimes it's just in person, old school, get to know somebody before you hand them their money.
I wouldn't invest with anybody otherwise.
Yeah.
You're 100% right. And I'm taking my fund manager hat off and putting my investor hat on when I say that. But the investments that we have in funds and syndications outside of our own are all with guys I consider friends. I have their telephone number in my phone. I can reach out to them at any time, and we're going to go to that right next on the next slide. So the relationship by far is the most important part. Going on a website, whether it's crowdfund or there's a million different websites out there now where you can find alternative investments. To me, that's just like playing Russian roulette. I would just never do that with my retirement dollars.
Right. And I do notes, and I can't think of a note that I funded out of my self-directed account that was to somebody I didn't know for less than a year. All the people that I've done deals with are people that I know, I trust, and I had a relationship with them as an individual before I even thought about investing in one of their deals.
Absolutely. Absolutely. Because here's the reality. This is why we're spending so much time on the people part of the due diligence. The people make or break the deal. Every time. The people make the deal. That's why I put it first on my due diligence list, because it is the most important of those three categories. And let's be honest, the wrong operator could screw up a good project with a good property. If you had the wrong operator, they could screw up anything, right? And conversely, the right operator could make money on an average property with an average project scope.
Right.
It's about the operator always. It is not about the deal. So make sure you're working with a team that you enjoy working with, and make sure that the operator is accessible, right? When I held up my phone, that's somebody that's accessible. All my investors have my cell phone number, they have my email address. And if they ever have any questions, if they ever have any concerns, if they ever wake up in the middle of the night scared about their investment, they can reach out to me and they're going to get the answers to their questions. Make sure that the person you're dealing with is willing to be that transparent and that available to you, because it's your money. You deserve that. Now, off to the project. The project itself, this is really two parts. It's the people, it's the property itself and the business model or strategy. Those two components make up the project due diligence. So I might really love the property, but I think the business model or the strategy of this sponsor is horrible. Well, if that's the case, I'm not in, because I'm just not loving the project. I might love the property itself, but I don't think their model, or I don't think their strategy for that property is going to be a winning one. So does the model or strategy seem like something you want to invest in? There are things out there that it just doesn't go with my morals. It doesn't go with my values. It's crazy some of the things that I get in my email for me to invest in. And some of them I'm just like, it might be profitable, but no, I just don't want to do that. It's just not something I want to invest in. Is the project in a good area for that particular strategy? There are projects that'll work. There are strategies that'll work, but they won't work everywhere, right? They will only work in certain areas and they won't work in others. These are questions that you've got to ask. You cannot assume that the sponsor has all the right answers. They may, and they should, because they're supposed to be experienced, but sometimes people make a bonehead move too. How big is the project? Do you want to invest in things that are really long projects with heavy lifts? Now, a heavy lift means a large construction component. The bigger the lift or the bigger the construction component, the bigger the risk, which means at the end, you should have a bigger reward if you do go into those particular projects. If it's a real safe, easy, stable asset, short timeline, very little rehab, very little construction, you should not make as much on that project as you would on a major reposition deal, because risk equals rate. It always has and it always will. Another question I always ask on the project side is, how long will it take this project to get to break even? Now, if this is a big, heavy lift, the answer might be when we're done, right? It's going to take us 5 years to get this thing done, and then we're going to sell it, but we're going to triple our money. Well, really, there's no cash flow at all until the end, and there's not even a break even until the end. That's a really risky endeavor. Doesn't mean you shouldn't do it, but if you do, you should be compensated extremely heavily for it. Now, that takes me to the biggest challenge in this section, and that is assumptions. Assumptions are the things that we assume, obviously, are going to pan out, that is going to create this profitable project. We're assuming that we're going to be able to raise the net operating income of this property. We're assuming that our CapEx is only going to be at this. We're assuming that our expenses are going to go up at this rate. And we're assuming at the end that we're going to be able to sell at this particular capitalization rate. All of those things are assumptions. None of them are set in stone. And you know, I grew up on a farm in Appalachia, and there was a saying I was taught by the farmers when I was growing up. The saying goes that figures don't lie, but liars sure can figure. And what that is to say is, you don't want to just rely on numbers you're given. You want to dig deeper to see if people are spinning or fudging those numbers to come to an outcome of their desire. And there is no place in life that I have ever found that quote more appropriate than here on this slide when we're talking about assumptions. So knowing that and really watching for that all my life, what we did when we put together our funds is we said, these are our assumptions. They are highlighted, and we have outlined exactly what every assumption is that leads us to our conclusion on what our expected rate of return is. And that way I can walk through with a potential investor and say, this is what we think we're going to be able to raise the net operating income by, and this is how we're going to do it. Do you agree with us that that is possible? And then if the answer is yes, we move on to the next one, and we continue to do that all the way down the sheet. If at any point an investor says, no, I don't think that's possible, Tom, which, by the way, I've never had anybody say that, because I try to be ultra conservative with every assumption. What I want to do is overperform at the end after under-promising in the beginning. But a lot of investment guys that are out there putting together these funds and syndications, in my opinion, they bloat everything and overpromise. And then when they underdeliver, they make excuses. So make sure you're really challenging, even me, challenge every one of my assumptions. And if you don't think any of these assumptions are accurate, then obviously that's not an investment you should endeavor into. And I use that as one of my qualification criteria as well. When we start getting payouts, that's important. You know, I talked about in an earlier slide, there are some that immediately start paying out because they have cash flow to distribute. Others, you don't get paid to the end. Is there a pref or a preferred return in this investment? And if so, where does the money come from to pay out the pref? I have literally seen syndications that had no cash flow, but were paying out a pref on a quarterly basis until they got the property repositioned and cash flowing. Well, you understand there's only one place that money can come from, and that is new investors. And that is the textbook definition of a Ponzi scheme. Taking new investor capital to pay a current investor, that is just absolutely taboo, absolutely taboo. But I have seen time and time again over the years, funds that were set up, or syndications as well, that were set up in that way. And then lastly, what is the lockup period and what is the projected hold period? In a fund, it's called the lockup, and in a syndication, projected hold. So those are the due diligence questions I would ask on the project itself.
Hey, Tom, I have a question. I have a quick question from David. David says, how do you determine if the risk or reward is balanced? I think of a range of return on investments, which is based on my own experience, but I don't know if it's good or bad. Do you have anything to speak to that?
Yes, he's absolutely right. It is very hard, and it changes with the market. It changes with interest rates. So you've got to determine what I call market clearing for that particular type of investment. And I could give you a couple of examples. A note fund, such as our current note funds. I think an acceptable range on a note fund is going to be somewhere between 9 and 11%. Where in that would be determined by the risk factor in those notes themselves. Are they performing notes? Are they non-performing notes? Are they income producing notes? Are they fix and flip notes? Those types of things would dictate whether it's at the higher or lower end of that 9 to 11% range. And I've seen some that are paying 8 in the 8 range as well on performing notes. I think that's a little low based on some of the others that I see. Now, if you go to, let's say, the shopping center we just bought, and we did put together a fund, a single asset fund for that particular shopping center. It's 100% occupied. It just went through a $1.2 million rehab, so there's no construction needed. It's completely full. It's cash flowing day one and paying out. We expect it to pay between 6 and 8% on an annualized basis quarterly based on its cash flow, its income. But we expect at sale, because we bought it under market price, to be able to get a big kicker to push our investors over 15%. Now, on a stable asset, I think 10 to 15% is very strong. On a stable asset, we're going to have a pass-through of depreciation. That's going to be very helpful for the investors. So there are a lot of factors to it. But if I were buying a busted up, ugly shopping center at 30% occupancy, and it needs $2 million in repairs, and then I have to backfill it with tenants, and I expect it's going to take me 2 to 3 years to get it to break even, I better come to you with a 20% expected return or better for you to put money in that. I would say that particular project needs to be 20 to 25% expected return to investor. So I think, and again, that's just opinions, one man's opinion based on doing this every day, all day for a number of years. But those numbers will change as the market changes as well. But I hope that provided you with 3 extreme examples, and pretty much anything else that you're going to look at is going to fall in between those somewhere.
No, that's great. And one thing that I picked up on that maybe some of you other listeners picked up on is Tom mentioned depreciation. Now, in some of these investments, we kind of touched on UBIT, and we'll touch on it after Tom's done. But if I'm in an investment that may incur UBIT, it's not the end of the world. It just means your IRA investment may be subject to tax. But guess what? When your IRA becomes a taxpayer, now it can use depreciation and all those tax tricks that people outside of their IRA are using. Now you can use it inside of the IRA. So not the end of the world, but that's something that I picked up from Tom as he was talking about that. Is you want to hear that from your investment sponsor or who you're investing with, is if you're worried about UBIT, ask if there's some depreciation.
Exactly. The last one, and the one that I'll spend the least amount of time on because I'm already almost out of time, is the hardest one probably, and that's the paperwork due diligence. This is sometimes called the controlling documents, and it basically lays out the rules of the road. I got to be honest with you, most of the time, this paperwork is never given a second thought. I would use an analogy of property insurance, most people do not read their insurance policy on their home or their investment property unless they have a fire, right? And then if you have a fire or some other peril that you want to turn in to the insurance company, what is the very first thing you do? You find that insurance policy and start reading it. And I would argue that is probably not the right time to be reading that policy for the first time. I think that time has since passed. And it's the same way with the controlling documents in an investment. If you're not comfortable or confident in reading and understanding the paperwork involved in an investment, hire somebody to do it for you. Most generally, you would want to hire an attorney to do that for you. And a very small fee could save you a ton of money in a large investment loss in the long run. Now, I would also say this because I have seen this time and time again from attorneys. I have some very good friends that are attorneys, but attorneys by nature, when you hire them to do due diligence on paperwork, they think their job is to do the due diligence on the entire project and tell you whether it's a good project or not. And I will tell you, most attorneys are not qualified to do that. But I've never heard an attorney utter the words, "I'm not qualified" for anything out of their mouths. So be careful when you do, or if you do, hire an attorney to do the due diligence on the paperwork and make sure that they understand that they are being hired for a very limited scope. And that scope only covers the paperwork, unless you feel that that particular attorney is qualified to do more than that. And it is rare that you're going to find that. A small sampling of the paperwork due diligence, you're going to run across things called private placement memorandums, or PPMs, operating agreements, subscription agreements, sales flyers or offering memorandums, and something else called a pitch deck. All of these things are governed. However, most private funds and most syndications are not fully registered investments through the SEC or the state securities commissions or boards. So they kind of fly under the radar. And the only time that these regulatory agencies are going to get involved in a private investment offering is if something goes wrong. And again, that's too late. You want to make sure you're doing all of your due diligence up front before you wire your funds to somebody for an investment. Because after that, well, it's kind of like reading your insurance policy after the fire. Look, due diligence is a skill. I have people all the time tell me, "This is just too much, Tom. That's just too much. I don't want to do all that work." And I would simply say, then put your money in the bank. Because in a bank, it's a depository and there is no due diligence involved. It's federally backed up to $250,000 through the FDIC, and you'll just be happy with the returns that you get. Now, obviously, I'm being a little snide and facetious here, but saving money in a depository takes no skill. It takes no thought. It takes no training. But investing money does. It takes research, training, knowledge, and you've already started the first step by being on this call. The difference in returns between saving and investing is huge, and it's definitely worth the effort. It's definitely worth the effort. And it really doesn't matter whether you're investing in stocks, options, currency, metals, real estate. They all require due diligence. The only thing that really doesn't is a depository investment, or excuse me, a depository savings. Everything else should take some due diligence. With that, I am through, and that is my contact info and our websites. If you want to learn more about our funds that I mentioned, there's a site for that. ILS.cash is where you would go if you were looking for loans for real estate investment property. And if you want to learn more about me and what I do in all of my real estate and other business endeavors, Tom Berry REI is my personal website. to reach out to me with a question, and I encourage you to do that if you feel like that. Tom at ILS.cash. I am the only one that sees those emails, and I answer every one of them. And to follow my real estate and business exploits, do so on Facebook. My handle is Tom Berry, REI. You can do that on all the other social media as well. I'm just not the guy answering those. I am the guy answering the one on Facebook, but same handle on Twitter and all the other places as well. Nate, back to you.
Thanks, Tom. Another great presentation. I hope you guys enjoyed this, especially if you're new, if you're experienced. I think Tom dropped a lot of golden nuggets for you guys. Tom, I got a couple questions. Is this presentation available for anybody that wants to reach out to you? Do you share the slides?
I don't,
Okay.
just simply because my legal director says I shouldn't, and I don't even know why.
No problem. Anybody that watches the recording, though, if you follow us on YouTube, we do upload these as a recorded segment, so you can go back and revert and watch it again. I would say save this one for sure. Rewatch it before you invest into a syndication or a fund or anything else like that. Tom dropped some great information there. I do want to just touch on one thing real quick. If you could stop share, Tom, I'm just going to share a couple slides here. Because I know I did get some questions even before the show, and Tom kind of mentioned it about UBIT and UDFI. Okay, now can you guys see my screen there?
Yes.
Tom, can you see my screen? Okay.
Yes.
So some of the questions you guys want to ask yourself, and first, let me just set the tone here. UBIT and UDFI is not something to be scared of. It's just something to be aware of. And for those of you who are beginners, who are just learning about self-directed IRAs, probably just put your earmuffs on right now, because I don't want to confuse anybody. But there's a lot of investors that know about certain investments that an IRA may have to pay a little bit of tax. Now, for simplicity, there's two investments that we're usually concerned with in an IRA, or we're usually looking at UBIT or UDFI. One, is my IRA invested into a business, a trade or a business that has active income, not passive income? The reason why that's important is because if you're invested into an investment that's kicking off passive income to your IRA, you don't have to worry about UBIT. But if you're invested into a business that's a trade or a business, for example, I'll say if you're, and I've had a client use his IRA to buy an ice cream shop. Well, an ice cream shop is a business. It's not real estate. So when an IRA owns a business like that, it is subject to UBIT. Doesn't mean it's a bad investment. It just means that your IRA has to share a little bit of a tax with Uncle Sam. They didn't do that. IRAs would have a huge advantage over the average business owner, because every IRA would go out and own businesses and just run everybody else out of business because they wouldn't have to pay tax. So it's a leveling of the playing field, but most syndications and most funds are kicking off passive income. So ask your investment provider, is it income passive or is it active? If you are putting your IRA in a situation where it's paying a tax, great. Now your IRA can use depreciation, it can use other tax credits. Even if you're investing in things like oil and gas, there's some tax credits that sometimes offset the income. So again, it's not the end of the world. You just want to ask first, am I going to be subject to UBIT? And what types of compensating factors will help me minimize this UBIT if I'm subject to it? The other type of tax that we're always looking at from a self-directed IRA standpoint is the unrelated debt financed income tax. Now, this can come with a lot of the syndications out there, especially if it's somebody that's buying an apartment and that apartment syndicator is going out and borrowing money from a bank. Well, in that case, the investment is considered debt leveraged. And anytime your IRA owns debt leveraged property, it may have to pick up a little bit of tax based on the debt piece, not based on the undebt piece, but the debt piece. So long story short, if I have 80% down from investors and my own money, and I borrow 20% from a bank to buy this property, well, only 20% of my income is subject to tax. But it's based on the net income, and it's based on when I get paid. So another thing that you want to look at in these syndication deals, and Tom mentioned this a bunch of times, is when do I get paid? I'm not getting paid, if I'm not getting any income to my IRA for say 5 years, well, A, I don't have to worry about paying any tax when there's no income. But then also, again, once you have a taxable piece to your income, you can use depreciation, you can use expenses to oftentimes whittle that income down. I'll just tell you this, you don't want to come to the self-directed IRA custodian to help you factor this in. You want to find a competent attorney or competent tax attorney that can analyze this for you. And I will just tell you this, in almost every circumstance, I've seen a client take his IRA and invest in something that had UBIT or UDFI. The tax was a lot lower than they thought it was, because again, you can offset the tax in many cases, depending on what types of tax credits or depreciation you can use. The other thing for those of you who are self-employed, if you have a solo 401k, solo 401k is a great tool to use, a great vehicle to use if you're buying debt leveraged investments or investing into a syndication or into a fund that might have some UDFI, because there is a built-in exemption only on 401k, so a solo 401k, where you don't even have to pay the tax. So don't get scared with UBIT or UDFI. There's always a solution in there somewhere to help you minimize it. And what I would ask yourself is, as you analyze those numbers, look at this. What's my cash on cash return? Don't get tied up in how much tax your IRA is paying, because sometimes borrowing money from a bank enables a syndicator to buy a bigger investment than they could have without the bank financing. So look at what your cash on cash return is, not so much how much I'm paying in tax, and compare that cash on cash return to your alternatives. And I think Tom mentioned, is if your alternative is a savings account at a bank, well, outweigh what you're making on that bank savings account to an investment that might have some pretty good cash on cash return, and don't get scared because you got to pay a little bit of tax on that investment. Tom, you want to add anything to that?
Not at all. Not at all. You covered it well, as always, sir.
All right. Here, we're going to take a little bit of couple questions and see if we've got some more questions here for Tom. I'll just throw out some comments. Thank you. Great presentation. Very well done. This is all good info. I think it's just all commending you, Tom, on all this stuff. So let me see with the here's one question from Mark. With the syndication, can an SDIRA be involved more than just passively? Can an individual become a principal general? Okay, I can answer this question. In most cases, no. Yeah, in most cases, no. That's kind of a hot word, a trigger word you don't want to use around an IRS agent is active. You want to stay passive, especially when it's with your retirement account. Because remember, we have retirement accounts with great tax savings, but it's for investing for retirement. The IRS is really big sticklers about you being an active participant in the investments your IRA is making, because you're the fiduciary to your IRA. You have a responsibility to make it grow. But once you cross that line and invest your IRA into something that you're managing personally, you might be doing some sweat equity on it. Well, now you've got a conflict of interest between, well, should I watch out for my own money because I'm active in this and spite my IRA, or should I, kick back some income to my IRA? You just muddy the whole water up. So always stay passive. You're always passive. You don't want to be an active participant. But if you're looking to use IRAs as an active source, look to other people's IRAs. Other people's IRAs, there's $35 trillion in other people's IRAs. So what I always say is, think of your retirement account in two ways. One, my retirement account is for the future. I invest that passively. But if I want to make money today using IRAs, use other people's IRAs, other people's funds that might be sitting there, and invest that into your deals and hopefully giving them great returns like Tom's been doing for many, many years. So great question. One last question. If I invest in a rental for rehab part, then we go group LLC, refinance. I have a rental. Would I pay UBIT? Let me read that again. If I invest in a rental for a rehab part, then LLC, refinance the rental, and have it as a rental, would I have to pay UBIT? So I think we can summarize that. If your IRA has a property and that property has debt on it, whether it's through a purchase or through a refinance, you then put your IRA in a position where it might have to pay tax. And I think I mentioned how to get around that. If you're using a solo 401k, you absolutely don't have to pay that tax. But I have seen clients do this. And again, this is why I say don't be scared of this UDFI or UBIT. I've seen clients who own property free and clear in their retirement account. they get a refinance from a bank, so they have some extra capital in their IRA that enables them to go buy 2 more properties, or enables them to do a rehab to increase the value of that property. So again, it's all back to cash on cash return. I wouldn't say getting a loan from a bank on an IRA owned property is a bad thing. It just depends on what are you going to do with that debt. Are you going to maximize it and invest in other things? Then it might be a good play for you. So great question. Tom, this was awesome. I really appreciate you being here. I hope we can have you on again. Any final words for our audience out there?
Well, yes. Right now I'm seeing a lot of fear among investors because of where we are, and things are kind of uncertain. We've gone through a decade and a half, maybe closer to 2 decades of really, really easy, good times as investors. And I alluded to that earlier in my presentation. And I think people are just scared because they have not seen the situation we have right now. I would argue, if I had time to do so eloquently, that we are now in a more normal period historically than what we have just left. Although people think we were in a normal, now this is horribly abnormal, and they're hopeful that we'll get back to what we left. I don't see that happening, at least not anytime in the next couple, 3 years. I think this is normal, and I could show Federal Reserve charts to prove my point. But until people get this comfort with where we are now, we've got this perception that the sky is falling, and it's not. But I love that there are those that think it is, because that has taken a lot of the competition out of the marketplace and is allowing for us to buy properties already at hugely discounted prices. Our first shopping center we bought at a $1.5 million discount to the as-is appraisal the day we closed. And the second one was almost $1 million discount. So to be able to pick up that kind of equity and share it with our investors and ourselves, we wouldn't have had these opportunities just a year ago. We certainly wouldn't have had these opportunities 2, 3, 4, and 5 years ago. But now we do. So rather than being scared, just get educated, because now's the time. For the next 12 to 18 months, we're going to be able to pick up phenomenal amounts of wealth. If you hitch your wagon to guys and gals that know what they're doing and have been through this before, they'll help you build some wealth.
Yeah, it's the old Warren Buffett mentality. It's, be fearful when others are not, and when others are not, be fearful.
That's exactly right.
I think you nailed it right on the head. Thanks again, Tom. I just want to remind everybody that if you guys want to reach out to me, Tom shared his email earlier. Tom, if you want to spit out your email again real quick. Tom.
Sure.
Yep.
It is tom@ils.cash.
Awesome.
tom@ils.cash. If you want to type it into the chat there, I don't think I can get it.
Austin, if you could type that into the chat, I'd appreciate it. And if you guys can see my screen there, there's my email. If you guys are interested in setting up self-directed IRAs to start investing in alternatives, for being on this program or watching our workshop, always use that coupon code RYR100. That's Rethinking Your Retirement 100. That gets you $100 off the first year's fees with Directed, and that counts for every single account you open. So if you want to open an account for yourself, for your spouse, for your children, you'll get multiple credits by opening multiple accounts. So I hope this was helpful to you guys. Tom, thanks again for being with us. I know we went a little bit over, so I hope we're not keeping you from anything, but I love having you on the program and love seeing you.
Thank you very much. Anytime, Nate, anytime.
All right. And thanks for everybody for joining. See you guys next time.